Basic indicators. So now that we have had a chance to, in this first part of the lecture, to go through charts and chart construction, what we will do in the remainder of this lecture is go through basic indicators. We will go through some of the indicators that are most commonly used in technical analysis. From the first lecture, we know that as we go through when we went through the course outline, if we remember, we will be devoting an entire module, a 5-lecture module, to discussing technical indicators. So this will just be an introduction. And the idea of doing the introduction is just to get yourselves acquainted with, firstly, charts and how to construct them, how to play around with them, and indicators, we'll look at how to construct them, and again, how to play around with different settings. So what we'll discuss this lecture are 3 different indicators. These are 3 of the most common and popular indicators. They are moving averages, Bollinger Bands, and the relative strength index. We won't go through in detail how these indicators are calculated. That will be in module 3. What we will do in this lecture is we will plot these on a graph so that we can see what it looks like and how it works. And we'll of course briefly tell you what these indicators mean. What is an indicator? Well, before we plot the indicator, let's discuss what it is to begin with. An indicator is a numerical value that is calculated as some function of the price. So all indicators are numbers. Okay, they are a number, any number it could be, and that number is calculated based on the past price history of the stock you're looking at. So the value of any indicator will depend on the current price of the stock, as well as the previous values or previous prices of the stock. And they can be, the previous prices over the last week, or the previous prices over the last year. It really depends on what indicator we're using. The point is we can use any amount of historical data to calculate an indicator. What we will always do is we will always be using the current price, and we will always use some previous values. So it might only be yesterday's value and the day before's, or it might be a whole year's value. Now, an important concept to know is that indicators are what is known as lagging. Lagging means that they are based on what has happened in the past. And we'll talk about this later on, as this is one of the sort of weaknesses of indicators, is that they are only based on what has happened in the past, and they're not as forward-looking, maybe. This is one of the criticisms. We'll talk about it a lot later on when we go through indicators in more detail. And we'll also talk about what is useful about indicators and how we can use them to create technical trading strategies. Moving averages. As mentioned, we will be going through 3 different indicators in the rest of this lecture. The first of these is moving averages. Now, moving averages are one of the most common indicators out there. What is a moving average? So if we have an X-day moving averages, an X-day moving average is equal to the average price over X days. And X can be any value you want it to be. So for example, if we have a 5-day moving average, then the 5-day moving average is equal to the average price over the last 5 days. Likewise, if we have a 20-day moving average, that is equal to the average price over 20 days. Now, we can replace days with minutes or weeks. It depends on the time frame of the chart. If we're using a weekly chart, it'll use the average price over the past 5 weeks instead of days or minutes, etc. But the most common one to use is day. So we tend to look at moving averages in days. Now, moving averages are smoother than the actual price. They're less volatile, and we will see this when we look at an example. The reason for this is that it's not as affected by one-off large drops or falls in price, because it's if you're taking the average of price over many days, the average will always be smoother than the actual price itself. Moving averages, the longer dated they are, the more smooth they will be. So what we'll see is that a 20-day moving average is more smooth than a 5-day moving average. A 50-day moving average is more smooth than a 20-day moving average, and so on. In general, there are two types of moving averages. We have simple moving averages and exponential moving averages. We won't go into the math behind them. We might do that. We will do that in later lectures. But for now, just know the following. So a simple moving average is what we said before, which was the average price over X number of days. An exponential moving average essentially places more weight on more recent data. So it looks at prices over a certain period of time, but it puts more weight on the more recent prices. And that's the difference between the two. So why are moving averages useful? Well, there are many trading strategies that come out of moving averages. So I want to talk about a fairly simple one, which is very commonly used and can work very well in certain market conditions. So one of the trading strategies is known as a moving average crossover. Essentially what we do is we plot two different moving averages, one slow one and one fast one. So for example, we might use, let's say, the 5-day moving average and the 20-day moving average. Now we plot both of those on a graph. When the faster moving averages crosses the slower one from below, then it is a buy signal. So the faster in this case is the 5-day and the slower is the 20-day. So if the fast one, that is the 5-day, is currently below the 20-day and then crosses the 20-day from below, so it crosses and then goes above it, that's a buy signal. And conversely, when the faster one, when the 5-day one is above the 20-day and then crosses it to end up going below, so it crosses it from above to go below, that is a sell signal. And this is the moving average crossover strategy. Essentially, it is a trend following strategy. It is used to identify when there's a change in the trend and to buy when the trend goes upwards, sell when the trend goes downwards. Again, fairly simple strategy. In practice can work reasonably well. So what we'll do now is go back to Yahoo Finance and we'll take a look at an example and see how it works. Now here we are back to Yahoo Finance with Maruthi. So we'll go back to the usual chart, mountain chart in this case. And here we have the stock price over 3 months. Now let's do it over, I want to try and maximize data points we have. So if we take it over 1 year, this is probably quite good enough. This is still a daily chart. As you can see, this is the price at each day. Now what we can do, and this is one of the great things about Yahoo Finance, is that there are tons of technical indicators, as you can see here, that we can plot. So by default, volume was already selected. So now what we want to do is plot a moving average. So we'll go with a simple moving average. And we want to know the number of days we can do this moving average for. So let's say if we go to our example, we do a 5-day moving average and then we do a 20-day moving average. Okay, and we can see what it looks like here. Now what we can see is that the 5-day moving average is the red line and the 20-day moving average is the green line. It might be better to see this on a 6-month chart actually. Let's see if we can see it better. Okay, I think a 6-month chart is good here. Now what we can see is that the 5-day moving average is more volatile than this 20-day moving average, which is the green one. And they often cross, right? There's a cross here, there's a cross here, there's a cross here, etc. And this is how we plot a moving average. Now, for example, if we wanted to create a trading strategy that was a moving average crossover, we would buy when the red line crosses the green line. So in this case, when the red line crosses the green line from below, so up here, that would be a buy signal. And this is essentially saying an uptrend has begun. This would be a good buy because look, the price keeps going up after that. And here, for example, when the red line crosses from above and goes below, that would be a sell signal. In this case, the price actually went up afterwards, so we would lose a little money. And here, for example, we have when the red line crosses the green line from above, this would be a sell signal, and again the price falls, so we would make money here. So we can see that this moving average crossover strategy can be fairly good. And we can then, we can change it from 5 to 20. We can go, if we want, 20-day and let's say a 50-day, and this will be even smoother than before. So this might be more applicable, let's say, if we have a 1-year chart. And so we can do these moving average crossover strategies with any two different moving averages. So we use 5 and 20, we can use 20 and 50, we can use 50 and 200 if we want to. And which one to use can be quite tricky, and when we talk about technical trading systems and strategies, we'll talk about ways to figure out the best one. Bollinger Bands. The next indicator we will talk about are Bollinger Bands. Now, Bollinger Bands are used to determine whether a security is overbought or oversold. Now, the calculation is slightly complex. We'll talk about it a little bit later. Essentially, what we have when we plot a Bollinger Band is that we'll have the price, okay? And with the price, we will have two bands above that price, an upper band and a lower band. And these will be on either side of the price. And the width of the band, okay, that is kind of the distance between the actual price and one end of the band, that depends on the volatility of the asset in question. So the more volatile the asset, the greater the size of the band. Right? So the band is supposed to tell you how much should the stock price be moving, and it should always be staying within that band, essentially. And when it goes out of the band, that is an indication that it may be overbought or oversold. Okay, let's carry on. What is a trading strategy we can use with Bollinger Bands? The main trading strategy is that our basic premise of Bollinger Bands is that the price should most of the time stay within those bands. And if it goes out of those bands, it should then come back into those bands. So if the price dips below the lower band, in that scenario, the security is oversold. So what we should do is buy the asset. We should buy the stock when it falls below the band. And on the flip side, we should sell the asset or sell the stock when it jumps above the upper band. When it jumps above the upper band, in that scenario, the security is overbought. Now, this kind of strategy is a reversal strategy. It aims to profit from a reversal in the price after a sharp move. So the price will fall, for example, below its Bollinger Band if it falls down very sharply very quickly, and we think that it will reverse back up. And this is kind of in contrast to the moving average scenario where that was a trend following strategy. This is a reversal strategy. So it's a different kind of strategy. And now let's go back to Yahoo Finance to see what that looks like. Back to our chart here. So what we're going to do now is first remove the moving averages. Okay. So now we just have the price graphed over 1 year. And now we can also go in here and plot Bollinger Bands. Now, this period and the deviation essentially tells us what we want the band to look like, and I won't explain what this means now. Essentially, the Bollinger Band is like it uses a moving average to calculate it. So in this case, it's saying should we use the 20-day moving averages, and this is the number of standard deviations. And I promise you, we'll go through this in full detail in later module. So don't worry if it doesn't. It's not very clear. I just want to draw it here and show you what it looks like. So here we have the band, and what we see is that the price, right, is generally within this band and occasionally goes out of the band. So if we think about our strategy, right, what was our strategy? Our strategy was that when the price goes below the band, we buy because it will reverse back up. When it goes above the band, then we should sell. So how well will that strategy work in this scenario? Well, here, for example, it went below the band. However, the price kept falling. So in that scenario, it would have lost money. Here, for example, when the price comes again below the band here, goes out of the band, then we would sell. Okay, so right here the price goes out of the band, we'd sell, and the price would very quickly come back down. Okay, and again when it came back down here, it would be at the other end of the band, we'd buy and it would go back up a little bit. When it came, for example, here, right at the band, we would buy at this point, and it would go up. We'd sell at this point because it was at the edge of the upper band, and it would come down. So as you can see, because the price tends to stay within the Bollinger Band, we can create a trading strategy based on it. Okay? And you can see from this graph is that this trading strategy would work pretty well. And that's a good thing. Obviously, which indicator to use depends on the market condition, but in this case we can see that the Bollinger Band would work fairly well. Relative Strength Index. The final indicator we will discuss in this lecture is what is known as the Relative Strength Index, also abbreviated as RSI. The RSI is a value between 0 and 100. And it is calculated based on previous up or down moves in the price. And of course, in the later modules, we will go through exactly how it is calculated. And essentially, it looks at the previous day's price changes and tells us whether a security is overbought or oversold. So if there are a lot of days when the price has gone up continuously, then the RSI will be high. It will be close to 100. If the price has mostly been going down recently, the RSI will be closer to 0, or to be lower. And typically, when we have an RSI that's above 70, this means that a security is overbought. And when we have an RSI that is low, or below 30, it indicates that a security is oversold. And if it's in between these levels, it usually indicates neither overbought nor oversold. What about the fun stuff? How do we create a trading strategy using the Relative Strength Index? Now, like the Bollinger Bands, the RSI is also a reversal indicator, right? It's telling us when a security is overbought or oversold, which is exactly what the Bollinger Band did, right? With the Bollinger Band, when the price fell below the band, that was oversold, so we bought. When the price went above the band, that was overbought, so we sold. Now in this case, we're going to create a strategy in the same way. Now what we'll do is that when the RSI tells us that a security is oversold, then we will buy it. When the RSI tells us that a security is overbought, we will sell it. So a common strategy using the RSI is that if the RSI is below 30, we should buy, and if it's above 70, we should sell. Now, of course, this is not fixed. We could use 20 and 80 instead of 30 and 70, for example. And of course, later on, we'll go into finding out which one is best. Let's go back to Yahoo Finance and look at and see what this looks like. Back to our chart here. What we will do first is remove the Bollinger Bands. Okay, so we're back to the same chart we had before. Now what we'll do is we will plot the RSI, which is here, the Relative Strength Index. Now, again, I'm going to keep this period to 14. When we do the calculations, we'll see what this means. Essentially, it's looking at how many previous days we're looking at to create the RSI. But let's draw it here. Now, I'm just going to go down a little bit here. The RSI is actually down here. Okay, and as you can see, it is between 0 and 100. You can see the values up here. Alright, and it will tell us whether security is overbought or oversold. So let's try our simple trading strategy where if it's above 70, then we sell it, and if it's below 30, we buy it. Well, okay, so here, for example, the RSI goes to 78. That's above 70, and that means we should sell. And this would be a good strategy because if you look at what happened from here onwards, the price came down. So that would work well. Now, let's go to a situation where it was the other way around. Down here, we have the RSI of 23. Okay, and this means that we should buy. Now, what would happen if we had bought? Well, we would have actually been flat for a while. We would have probably, if we had stayed in the trade, we'd have made money, but chances are we may have gotten out because this would have come down. So that may not have been a great buy. And likewise here as well, we would see that the RSI is 84. This would tell us to sell, but actually the price kept going up. So in this case, what we can see is that the RSI is probably did not work as well as the other two strategies, and it likely would lead to more losses than gains just for this particular stock over this time period. Now, of course, like I said, I've repeated that different indicators work in different situations. So in fact is that we had 2 out of 3 indicators that worked well in the stock, that's pretty good. But anyway, this is just to give you an idea of the relative strength index. Now, what you can do is, well, you can look through all these different indicators and you can plot whatever you like. So I encourage you to do this on your own. You can change the chart settings, you can plot indicators, you can change time frames, etc. You can really, play around with it and get comfortable using it.